All right, so good evening to you guys. So we are starting the class officially today. I'm Onoja Emmanuel by name, popularly known as Onoskid FX. So from the scheme of work we have, the first thing I'll be introducing you guys to is, or the first topic we have is Introduction to Tradingview. We have Introduction to Derivative Synthetic Markets, and then Candlestick Anatomy and Candlestick Patterns. So these are the three things that we are going to cover in today's class. So I'll try as much as I can to uh, give the best explanation I can give. At the end of the presentation, if you have any question, I'll give room for question and answer. And also, if at any point in time you guys are probably there is a network break, you cannot hear me or something, someone should just call my attention. Okay, so but for now, I think in order to avoid interruption, you can just mute your mic so that there will be no interruption during the course of the presentation. So thank you. So like I said, today we are going to be looking at introduction to trading view and introduction to the synthetic market as well as candlestick anatomy and candlestick patterns. So these are the three things we'll be covering from our scheme of work, and I believe all of us are have the scheme of work written down in our notes. So TradingView is just a platform that you can use to analyze the market because you have a lot of tools on the TradingView that you can use. So it makes it very easy for you to probably do your analysis. You can see my trading view. I have set it up in this way. For instance, if you look at this pair, these are my these tools you're seeing here. These are my favorite tools, and you can actually get these tools from this side here. For instance, if I click on this, these are the various tools you have. All right, but the ones you see with star are my favorite, like the one I use most. So that is why you are seeing them here. For instance, if I remove this trend line, you see that it disappeared from here. If I click on this star, it's definitely going to appear here. So this is just my favorite tool, the ones I use mostly. So I make use of trend line, I make use of horizontal, I make use of this horizontal ray as well. And what do I use trend line to do? I use trend line to check for the trend of the market and for this particular trading view. This is a trading view that is meant for the forex market. I mean forex market are talking about the currency pair. Okay, so here we have the watch list. Watch lists are just like your favorite tools. What you actually want to, the pairs that you like trading the most. These are your watch lists. Okay, so this is just the few things. There are a lot of pairs that you can actually trade, but these are just the one I look out for mostly. This is the XY. The XY is just the dollar index. You use it to study what dollar the dollar currency is going to look like in relation to other. So because there are some pairs that are correlated, when I mean correlated means that they have some similar behavior. So like GBP USD and Euro USD, these are just an example of currency pair that you can trade, and this XAU USD is just good. All right, so that's that about this. There are a lot of tools here that you can actually see. So this is Fibonacci. Fibonacci is also a tool. I also make use of it. That is why you're saying here. What do I use Fibonacci to do? We also use it to we use Fibonacci to actually check for possible area where reversal is possible in the market. So that's what we use it to do. We just use it as it's a form of indicator, or we use it to add something like a confluence to our analysis. Then also we have, okay, all these are just, there are a lot of tools here, but I don't make use of them. This is long shot to tell you that if you want to take a buy in the market or you want to take a short is the same thing as you want to like sell the market. So this is also the tool we use in our, I use this brush just for indication. This is arrow to check the direction of the market. For instance, if I click on this arrow and I do something like this, so this is an indication just to show that okay, where are you expecting price to go next? That is just what the arrow is used for. So there are also we have this rectangular box. This is what we use to draw support and resistance. Then this part is more like a continuous arrow. For instance, the difference between this part and this arrow is that this one is continuous, while this one is just a straight arrow that shows indication of where you are proposing that the market price is going to go next. Okay, for instance, if I click on this part, I'll be able to do something like this. You can see, so it's continuous. So that's just the difference. So like I said, this is just the trading view for currency pair. And like I said, there are different pairs that you can actually trade here. But if you look at the first, if you look at the first note I dropped for you guys on the group, the WhatsApp group, I told us that our major focus is going to be the synthetic market. All right. Now, if you come here and I search for volatility. Okay, if I search for volatility index, or let's say volatility 50 or volatility 75 index, you're not going to see it among these pairs. Meanwhile, these are the various pairs that you can actually trade. Since we cannot find it here, there is also another trading view that contains these synthetic indices that we are interested in. All right, so and that will take us next to. Okay, like I said, the fact that the synthetic indices we are interested in, we cannot find those pairs that we want to trade in there. We cannot find it in this trading view. So there's need for us to actually make use of the trading view that is provided by that platform. So Deriv itself make it available for us to access a particular trading view that gives us access to trade this synthetic market. Okay, so like I said, this particular trading view is just for currency pair. The next trading view I will be taking us to, which is going to be our major focus, is the synthetic trading view. All right. So, and mind you, if you go through the information I dropped in the group, I told us that our major focus is going to be the synthetic market because there are various assets you can trade. You can trade crypto, you can trade for forex market like the like of currency pair like this. You can trade commodities and other stuff, binary options and all. So synthetics is also part of the things that you can trade as well. So that is just going to be our major emphasis for this class. But the knowledge you are going to get from this class, you can use it to trade any of this market of your choice. I've already said that in the message I dropped in the group. Okay, so I'm just going to take us through the synthetic trading view as well. Now, when you go to your browser, all you just need to do is type trading view, deriv.com trading view. When you type deriv.com trading view, it's going to show you something like this, or type trading view. Let me just show you. When you come to this place, you can type trading trading view trading view implementation. Yeah, trading view implementation for deriv.com. All right, and you enter. Okay, so this is what you are going to have. So when you see something like trading view implementation for deriv.com, you just have to click it and you allow the charts to load. So the moment it opens like this, the first thing you need to do is to create a name for yourself. This because this is where you're going to save all your analysis. That is the first thing you need to do. Okay, you create a name for yourself, then you just have to, when you click on this, they'll ask you to select a name. Just you can type in your name or any name of your choice, but I've already passed through this stage, so I'm just going to go. The most important thing is if you don't know how to go through this stage, there's already a video available for it. I'll drop it in the group for you guys to like go through it if you have any difficulty trying to create your name or you're having issue of you're not able to save your analysis. So I've created my own name. I'll just come here and load charts. You can see on Skid Effects, this is another person's name. So I'll just click on my name. Okay, so this is the platform. This is how it looks like. It looks very similar to the other ones are the one of currency pair. The difference is just few things that are not here and which are the pairs. We don't have most those currencies like GBP, USD and all. And then the watch list we have there, we don't have it in this platform. So when you look at this point, look at this region, these are the various tools you can actually use as well, just like the other ones I've shown you guys. When you come to this place, there are various tools here. You select the one that you are using. The one you're seeing start, they are just my favorite tools that I make use of. Just the trend line and the horizontal array. I use this horizontal array to mark out my market range. And this one, just like the name implies, it's for what? Drawing of trend line. This trend line is what I use in drawing this. Okay. So we have other tools here. This is Fibonacci. This is Fibonacci retracement. I also make use of it. You have you have rectangle, which is what it is just used for drawing support and resistance. This is what I use the rectangle to draw, something like this. Then this ellipse. Ellipse is just for indication. Probably when you have two double entries or thereabouts, just I use it to indicate that okay, for those of you who are in the VIP signal group where I drop signal, sometimes you will see something like this. If I have two entry, you see something like this. This is what I use the ellipse to do, and the indication of it is that it's used to show conservative kind of entry. If you have two entry in a particular analysis and you have this indication, it's telling you that yo bro, the first one might be an aggressive entry, but the second one is the conservative one. So that's that about that. Then this is text. You can see this is V751X. I use this text to do that. And this is where you have your long and short. Like I said, long is for buy, short is for sell. Okay, they use the word interchangeably. So what else? All right. So I think that is the most important thing here. This this eye, you can use it to disappear or everything that you have drawn. If you want to have a plain chart, when you click on this eyes, it's just going to disappear. Okay. So this is used. If you want to delete your tool, you can actually do that. So when you start trading, you know what you can use. Whatever one you can use, you can actually add it to your favorite. The most important thing is when you add it to your favorite, they are going to display at the top of your screen here. You can adjust it to any part of your screen, wherever you want it to be. It's just that I prefer my own being here. Okay. So the next thing is time frame. There are different time frame you can see here. Here are the various time frame you have. You can see that some of them has this star ticked. The ones that I've ticked are the one I make use of. The 5 minutes, 10 minutes, 15 minutes, 30 minutes per se, they're just my entry time frame. Basically, I don't exceed 15 minutes for my entries. And then the 4 hour and the daily is just what I use to check for my original buyers of the markets as my higher time frame because we have lower time frame and higher time frame. Okay, so that is that about the synthetic trading view. So I believe at the end of this phase, if you are new, if you have never visited this site, you can actually open your chart now and then try to look at what you can try to look at this platform to play around it, get yourself familiarized with the tools so that as you progress, you can actually start practicing whatever you are learning. So that is that about the trading view. The next thing I want us to talk about is candlestick anatomy. So please, whatever we'll be discussing from here is very, very important. Okay, so I urge you guys to try as much as you can to grab the concepts and don't assume you know anything. I mean, sorry, you know everything because no one is an island of knowledge. So you just have to um, open your mind to receive whatever it is that we can discuss today and then ask questions when there is need. Okay, so under candlestick anatomy, the three things I'll be interested in or I'll be sharing with you guys is number one is weak rejection. I'll be talking about weak rejection. I'll be talking about weak rejection. I'll be talking about power candles, and I'll also be talking about candle candlestick pattern. So these are the three things I will be talking about in this class. Okay. So before I proceed, it is important to let you know that candlestick is the language of the market. And I keep whenever I have the opportunity to talk about candlestick, I like making reference to how important it is that every trader or every aspiring trader should understand what candlesticks are because it will not be nice that you want to come into a particular atmosphere and you don't understand what is happening there or you visit a location or you travel out of your space to another location entirely and you don't understand the language they are speaking, it will be difficult for you to flow. The reason why you guys can relate to what I am saying is because I'm speaking a language that is common, which is the English. You guys can interpret what I am saying. That's why it is easy for you. So if you come into the forex space and you don't understand the language of the forex market, it will be difficult for you to make that progress because the market might be saying A, and because of the fact that you cannot interpret it, you will be paralyzed because you don't know the decision to make. You cannot interpret what the market is saying. So it's actually very important that you understand what candlesticks are. Like I said, candlestick is the language of the market. It gives you overview of what the market is saying, and from your knowledge of what it's saying, you can actually make good trading decision with it. So in trading the synthetic market. Okay, I've introduced you guys to the synthetic trading view. So before I proceed to talking about candlestick, I just want to show you guys that the kind of pairs that are available for you guys to trade. When you look at this point here, you see we have forex stock indices, commodity, derivative, and then currency, cryptocurrencies. So like I told you guys before now that there are different things that you can trade, all right? But what we are interested in is this derivative pair. Okay, so these are the various derivative pairs that is available for us. You have the likes of volatility, 10-1x. These derivative pairs, these are the pairs that are available you can trade under this particular platform. You have the jump index, we have boom and crash. There are some of us here who so much love boom and crash, and you guys are doing wonders. You guys are doing things with it. It's actually very, very okay. We have step index as well. So there are so many things you can trade here, and derivative are actually doing so much to even add more pairs. Okay, so another thing I want to say is that unlike the forex market, if you guys are familiar with it, the forex market have a unified lot size, which means that irrespective of the pair you want to trade in the forex market, when I'm referring to the forex market, I'm talking about currency pair. Okay, so the least lot size of it is 0.01, right? That is that of currency pair. But when you come to this derivative market, it has different lot size. Each pairs have a peculiar lot size. For instance, the least lot size of volatility 25-1s is different from the least lot size of volatility 25 index. As you progress and as you practice more, you will attain some level of flexibility on how you are going to go over, or because you don't need to cram all the least lot size. I don't know how long it will take you to do so. There's no point of you cramming it, but when you start trading, you know what to do. Okay, so that is that about that. I just want you to have it at the back of your mind that every pairs have a peculiar lot size. Okay, and also because of that, the volatility differs. Some pairs are more volatile than the other. If you notice, for those of you who are in the signal group, I keep telling whenever I drop some analysis, for instance, V51S, this particular guy is I call it the king of volatilities because it's actually very extremely volatile. And you see me making explanation like, please, if your account is below so amount, you don't have to take this, or I'm telling you that if you are taking this trade, be aware that you are risking so and so that it will not take you unaware, because you have to be prepared of what is to come and accept the risk before taking any trade. So the volatility varies from pair to pair, and it's important that you get yourself acquainted with how volatile they are so that you know the kind of pair that you want to trade with your account size. Okay, because you cannot have an account size of $10 and you want to trade V51S, or $20 is not even suitable unless you are okay or you know what you're doing and you want to take the risk. So that's that about the kind of pairs that we have to trade on the derivative synthetic market. Okay, so bringing us down to candlestick patterns. There are two types of candles. We have the bearish candle and the bullish candle. While the bearish candle is giving us a signal for a sell, the bullish candle is giving us a signal for a buy. For instance, the two colors you can actually see here is red and green. The green candle represents the bullish candle, while the red one represents the bullish, sorry, the red one represents the bearish candle. It is important that you understand that whatever is happening in the market is a battle between what we call supply and demand, or between buyer and seller. Okay, so those that are responsible for pushing price to the downside, they call them the bears or the sellers, and those that are responsible for pushing price to the upside, they call them the bulls or the buyers. Okay, so these are the two people that are responsible for moving price in the forex market. So having said that, we want to look at the concept of weak rejection. So the first thing I talked about is weak rejection. So weak rejection is very, very important in trading synthetic pair. And what do we mean by weak rejection, or how are wicks created? This is, let me show you what I mean by wick. When you have a candle like this, when you have a candle like this, okay, when you have a candle like this is, I have to draw another one as well. Let me call this one. Okay, these are basically two candles, all right? We have a bullish candle here and a bearish candle. So just for the anatomy of the candle, anatomy is just what are the composition of a particular thing. This is just when you're talking about anatomy, you're talking about the structure or what a particular item is made up of. Okay, so for a bullish candle, we have the open price here. We have the open price here. This is the open price. We have the closing price. We have the high, and then this is the body. The whole point here is called the body of the candle. Okay, so this is what a bullish candle is made up of. This is the open, this is the close, this is the body, and this is the high. The high is telling us that this is the highest point the market came to in a day. And then how this candle is formed is this. The moment this candle opens, the bulls came in and pushed the price from this open position to as high as this point in time. Then the bears, which are responsible for pushing price to the downside, came in and pushed this price to this particular point. But at this point in time, they exhaust their power. They could no longer push the price further, and the candle ended up closing in the favor of the bull. That is why this candle is called a bullish candle. So this is just the composition of a candle. We have the open, the close, and the high. And I told us that the high is the highest point that candle came to at that particular period of time. And this is the body of the candle. Now, this tiny wick, this tiny thing you're seeing here is what we refer to as the wick. Okay, is what we refer to as the weak. Now, what is the importance of weak rejection? Weak rejection tells us that there is a presence of an opposing force in that particular battle. There is a presence of an opposing force in that particular market time frame. For instance, this weak rejection I'm seeing here is telling me that there is also a presence of sellers. There are people at this particular point that are willing to push this price to the downside. So that is the significance of weak rejection. Now, coming down to this bearish candle, we have also the open of the candle is here. This is the open of the candle. We have the open of the candle here. We have the low. We have the body as usual, and also we have the close of the candle. Just like the interpretation of these ones, immediately this candle opens here, immediately this candle opens here, what you notice is that the sellers or the bear push this price to as low as this point. Then the bulls or the buyers came in and begin to push the price to the upside, because the bulls, their major work is to push price to the upside. That is the only work they do in the market. So they start pushing price, they start pushing it from this point all the way to this particular point. But at this point, they exhaust their power. They could no longer push the price further. So that is why we are having this long wick, and it is called wick rejection. And the interpretation of it is that there are people here who are willing to, or there are people here who are also participating for a buy. There are people opposing this sell, or there are people preventing this market from falling further. Okay, so I hope that that is taken. Okay, I hope that's taken. So that is that about the importance of weak rejection. All right, so I will just take you through the chart and show you, like I said, the implication of weak rejection. Whenever you see a weak rejection, it's telling you that there is a presence of an opposing force. That is just the significance of weak rejection. And I'm just going to show you how important it is in the on the chart now. Let me take this to the higher time frame. Okay, this is the 4 hour chart. Okay, this is the 4 hour chart. When you look at this particular point, when you look at this point, when you look at this point, you see the market coming to this particular direction. And what happened? What you're saying here is weak. You see the market rejecting from here, rejecting from here. And what next did you see? You see the market crashing all the way down. The market came up again. Before the market was able, like before the market started rallying to the downside again, what you see is what? Weak rejection. So as a trader, how you want to position yourself whenever you are spotting weak rejection on a particular level, it's to prepare that there is a possible um, there is probability that reversal is likely to happen in that particular market phase. Okay, so that is just the importance of weak rejection. So if I scroll through, you will see it later all over the chart. Before reversal happens, you will definitely see those weak. You can see it along this region as well. So okay, so you can see this is another weak rejection you see here. So at every point you see that market is about to reverse, one thing you will notice is the presence of weak rejection. Look at this particular level as well. You can see how the market is having that weak rejection. Look at this region. Look at this region as well. You can see this week. You see the market creating a lot of wicks. So once you notice a wick in a particular market, look at this point as well. You will see the market creating that weak rejection. So the most important thing, what I want you guys to pick from here is that weak rejection is telling you that there is a presence of an opposing force. What do I mean by an opposing force? And when you see the market was coming to the downside, but after this rejection, the opposing force here are those that are now willing that the market should start rallying to the upward direction instead of coming down. And one of the signs is this weak rejection that you see. That is why for those of you who are in my VIP group, whenever I drop signals and I will, or the market gets to our POI, one thing I will just tell you is wait for your rejection candle. Okay, wait for your rejection candle. That is a sign that is telling you that okay, once the market comes to a particular POI and you start seeing those rejection, it's a sign that the market wants to start reversing and start going in the opposite direction. So I hope that is taken. The next thing I want to talk about is power candle. Okay, so what are power candle? Power candles are the like of Maraboso candle, Harame, um, yeah. Okay, you can also classify inverted hammer candle as well. You can also put them as as a kind of power candle. What are their significance in the market? They are telling you that there is a huge presence of the opposing force. Like why rejection candle is telling you that there is presence. Power candle is telling you that there is not just a presence, but they are active. Yes, let me use the word active. There are active opposing force. They are not just there. They are active. They are already taking action. All right. So these are the like this is an example of a power candle. This is a Maraboso candle. This type of candle we call it Maraboso candle, and you can see how powerful it is. And once you see it, you can see how far the market rallying to the upward direction. You can see. So when you open your chart and you see the market creating this type of movement in the you creating this type of movement, it's an indication that for instance, look at this particular candles. If you notice, this 1 2 candle is able to cover like how many candles between this region and this region. You can see 1 2 3 4 5 6, almost 6 and 7 candles were covered by just those two candles. That is to tell you that the bears came into power. The bears are fully active here, and they've changed the direction of this market. So That is the significance of power candle. And as a trader, how you interpret such scenario is that the particular, if it is a bearish power candle that you are noticing, that is to tell you that the bears are fully active on that particular um, price. Okay, so that is that about power candles. The last thing we'll be discussing, according to what we have in our scheme of work, is, or according to what I said, I'm going to explain to you guys, is candlestick pattern. So candlestick patterns, when you talk, where candlestick patterns are just combination of two or more candles, and they have representation, they have interpretation. There are a lot of them. I will just give you a few, and then you can just start developing yourself. But you have to understand that the names is not as important as their implication. What they represent on the chart is much more important than their name. And the first one, the first candlestick patterns I'll be talking about is bullish engulfing candle. Okay, bullish engulfing candle is a two candlestick patterns, and they are responsible. They, when you see them, what they do is they give you an indication that price is likely to start going to the upward direction, just like the name implies, bullish engulfing candle. And I'll just show you that on the chart. The word engulf means to cover up. So to engulf something is to like to swallow the, you know how there's this particular animal, amoeba. The feeding process of amoeba is engulfing. How he just cover the prey, whatever he wants to eat, you just there's a way he does it, just cover it up and then it will swallow up the prey. So when you talk about bullish engulfing, we are talking about two candlestick pattern. The first candle out of these two candlestick, the first one will be a bearish candle, and the second one is a bullish candle. Now, the second candle must completely cover up the first one. That means that the bullish one, which is the green candle, must completely engulf the bear. So, for instance, look at these two candles here. Look at these two candles. Look at these two candles. This is the first one. We have the first one here, which is the red one, and the second one, which is what? The green one. And what happened? The green one completely engulfed the red one. And after that, what next do you see? You see the market rallying to the upward direction. So that is this is an example of a bullish engulfing candle. And this is how you spot them on the chart. Whenever you see two candles, the first one being red, the second one being bullish or green, and then the green one completely engulfing the second one, it is a two candlestick pattern, and we call such a pattern bullish engulfing candle. And the kind of indication is, as a trader, how you interpret it is that the market may likely to start going to the upward direction, and so you want to position yourself to take a buy. Now, one key thing you have to note is you cannot trade candlestick in isolation. Very, very important. You cannot trade candlestick in isolation. What it means is that for you to trade candlestick, um, you have to use it as a confluence to other things. You don't just come into the chart because you've learned about candlestick anatomy, and just like I talked about bullish engulfing candles, and whenever you see bullish engulfing candle, you start buying. No, you don't trade it like that. You have to look for other confluences. Confluences means adding other reasons why you should take a buy, like your market structure. What is the overall direction of the market? Are you on a support level? Are you on a resistance level? So you have to consider all of these things before taking any decision. So the key word is don't trade candlestick in isolation. So that is that about that. The next candlestick I want to talk about is bearish engulfing candle. Bearish engulfing candle is like an opposite of bullish engulfing candle, right? Why bullish engulfing candle give us a sign that market wants to start going in the upward direction. Bearish engulfing candles tells us that market wants to start going in the downward direction. So as a trader, whenever you spot a bearish engulfing candle, what should come to your mind, or the kind of decision you want to take, is to take a sell. All right. So how do you identify it? It's a two candlestick pattern. When I say two candlestick pattern, it means it actually composes of two candles. The first one is a bullish candle. The second one is a bearish candle. But the second candle must completely engulf the first one. That means that the bear candle must completely engulf the bullish candle, and that is what you call bearish engulfing candle. So I will just show you on the chart. This is also an example of a bullish engulfing candle. This is also an example of one. This is another example. There are a lot of them you can actually spot on the chart. So let me just check for um bearish engulfing candle. You actually want to see them in an uptrend where the market is actually trending to the upside, and then you see the market rallying to the downside. This is one of them. You can see this is a green candle, this is a red candle, but you see that the red candle completely engulfed this green candle. And what did you see? You see the market rallying to the downside. Okay. So let me see if you have another one. This is also another one. You see, this is the two candle, green and red. The red did what? Completely engulf the green. And what do you see next? You see the market rallying to the downside direction. So they are littered all over the chart. You also have tweezer top, we have tweezer bottom, we have evening star. Tweezer top is also a two candlestick pattern. Tweezer top, just like the name implies, is just two candles that are of equal height. Either one is bullish, one is bearish, vice versa. For a case of tweezer top, you see the first one being bearish and the second one being bullish. And what is the indication? It will tell you that the market wants to start going in the downward direction. When you see a tweezer button, you see it, the first one being a bearish candle and the second one being a bullish candle. And the indication of it, whenever you see a tweezer button, is that the market will start rallying to the downward direction. So that is that about candlestick. So the next step of okay, that's that about candlestick patterns. There are a lot of candlestick. I'm going to drop a PDF that you can actually use to learn candlestick if you are still having issues. So the aim of this class is for you to know what they represent, how to interpret them, the information they bring to you as a trader. So that's that about that. Then you can see here, look at this rejection candle. Rejection candle in synthetic trading is very important. So please make sure that you pay close attention to. It is one of the signs that you will use as your confirmatory entry. For me, before making most of the entries that I am making in my trading is based on rejection candle, because if I don't even use bullish engulfing candles as much as I use rejection candle, and the likes of rejection candles are your hammer or your inverted hammer. Inverted hammer is the opposite of hammer. Just those weak rejection. Look at this particular one. Look at this is a sweet rejection candle. Nothing will stop me if I spot this rejection on my lower time frame. Nothing will stop me from entering this, because provided that they are appearing on my POI. What do I mean by POI? Point of interest, the area I want to take a sell or a buy from. So that is that about candlestick patterns. The candles I've talked about here, I've talked about bullish engulfing candles, I've talked about bearish engulfing candle, I've mentioned evening star, I've mentioned evening star and morning star. There are three candlestick pattern. How it works or how it looks like is that I wish I can see them here. Let me just look for it. You don't need to cram all those candles. You may not be using all of them. It's just for the sake of knowledge so that you will know what they represent. But bullish evening star, where you want to see it, you see it on a support level. And what you see is the first candle is a bearish candle. The second candle is a doji. Doji is candle that is formed due to rejections. So this is an example of doji. This is an example of doji, or they call them doji or indecision candle. Indecision candle. So the first one being for evening star, the first candle is a bearish candle, the second one is a doji, and the next one is a bullish candle. So how you interpret it is the first one being a bearish candle is that the sellers are still in control. Then the second one being a doji is that both the sellers and buyer are still battling, but we have an indecision. Remember, I told you that they call the candle indecision candle. We have an indecision. So, as a trader, you don't know the kind of decision to make. You have to wait for the third one. Then the third one, being a bullish candle, tell you that at the end of this battle, the bulls won this race. So it closes in the favor of the bulls. So an it's a morning star. That's the type of candle you want to see when you want to take a buy from a particular support level. And then if you want to take a sell, you should be looking for evening star. They are just ways and opposite. The opposite of morning star is evening star. The opposite of hammer is inverted hammer, or some people may call it shooting star. The name doesn't matter. Just understand what they represent in the market. So I think this is where we are going to stop today. We are going to continue in our next class. If you have any question now, it's time for you to unmute your mic and ask your question. So I will just use like 3 to 5 minutes to attend to all your questions and we'll call it a day. Thank you so much for staying to the end of the class. All right, so if you have any question, you can actually bring it on now.